Welcome to Cost Saver Conversations. I'm Angela, and I ask the practical questions so you can quickly understand what matters. Today, I'm joined by Assad.
Hi, Angela. We are unpacking UK mortgage stress test, how to prepare for rate rises without losing your home today, and tying it back to the wider cost saver ecosystem, including tools like Mortgage Stress Test App UK, Rate Rise Affordability, so you can turn insights into action quickly.
Just a heads up before we dive in, we are your synthetic hosts. We are great with numbers, but as AI, we can sometimes be confidently wrong. Think of us as the digital versions of your most knowledgeable, slightly caffeinated friends.
Exactly. Treat this chat as a smart estimate only, not as professional financial guidance. Always check important details with official sources or a qualified expert before making any big decisions.
Hey, welcome back, everyone. So today we are getting into something that I think is genuinely keeping people up at night, UK mortgage stress tests. And I've got Assad here to help us make sense of it all. Hey, Assad.
Hey, Angela. Yeah, this is a big one. The phrase mortgage stress test sounds terrifying, but honestly, it's one of those things where understanding it properly just takes a lot of the fear away.
I hope so, because I'll be honest, I thought the Bank of England kind of got rid of all this back in 2022. So why are we still talking about it?
Yeah, so you're right, they did scrap one specific affordability rule, but the stress tests themselves, they absolutely still exist. The FCA, the Financial Conduct Authority, still requires every UK lender to check whether you could cope if rates went up. And the reason it matters now more than it has in years is just the sheer gap between what people fixed at and what's available now.
Right.
Like, base rates hit 5.25% in 2023. During the pandemic, they were at 0.1%. That's not a gentle shift. That's a completely different world.
So it's not that the test went away, it's that the conditions have changed so much that the test actually has real teeth now. It's not just a formality anymore.
Exactly. And here's the thing that really gets me. Roughly 1.5 million UK households come off fixed deals every single year. A lot of those people locked in at, 1.5% to 2.5%, and now they're staring at offers between 4% and 6%.
Oh, wow.
Yeah, and that's not a little adjustment.
No. I was looking at the numbers actually. On a £250,000 mortgage, going from 2% to 5% adds roughly £380 a month. That's £4,560 a year just gone from your take-home pay, which is kind of a lot.
It's a lot, especially when you layer on energy bills, food inflation, council tax rises, all of that squeezing at the same time. And that's exactly why lenders are being cautious. They're running a scenario saying, what if rates go up another 1% to 3%? Can this household still pay? And if the answer is no, the application gets declined or the loan size gets reduced.
I hadn't thought about it like that. It's actually meant to protect us, not just make our lives harder.
Right, exactly. And there was a really good example that stuck with me. Sarah and Ben from Leeds. They came off a 1.89% five-year fix in early 2024. Their $220,000 mortgage payment jumped from £925 to £1,285 overnight.
Wait, overnight? That's a 360 jump just like that?
Just like that. And because they hadn't budgeted for it, they spent the first 6 months in overdraft, paying 39.9% interest on the shortfall. So that $360 rise actually cost them closer to $470 a month once the overdraft interest was added on. It's a painful example of what happens when you don't prepare.
That's really sobering. Okay, so walk me through how this stress test actually works. What's happening behind the scenes?
So there are three overlapping checks running at the same time. The first is a proper affordability assessment. They take your gross income, deduct tax and national insurance, then subtract all your committed outgoings.
So, literally everything leaving your account each month?
Pretty much. Loan repayments, credit card minimums, child care, school fees if applicable, maintenance payments, insurance, council tax, utilities, subscriptions, memberships, pension contributions, the whole lot. What's left over is your disposable income, and that has to cover the mortgage payment, but not at today's rate, at a stressed rate. Does that make sense?
Yeah, yeah. So the what if it goes up rate? And I'm guessing that stressed rate isn't the same everywhere?
No, and this is the bit that catches people off guard. Some lenders use their standard variable rate plus a buffer. Others use a fixed reversion rate around 7 to 8%, and some just apply the initial rate plus 3%. So you could genuinely be approved by one lender and declined by another with identical paperwork.
That's wild. That seems so arbitrary.
It does, right? Which is why speaking to a whole-of-market broker is so important, but we'll get to that. Here's a practical tip, though. Every $30 monthly subscription you've got, that reduces your borrowing capacity by roughly $6,000.
Wait, really? $6,000 for a $30 subscription?
Yeah, lenders look at your recent statements, so canceling dormant subscriptions and clearing small credit card balances at least 3 months before you apply, that can genuinely shift how much they'll lend you.
That's actually shocking. Okay, what's the second check?
Credit profile. They want to see how you've handled money. Payment history, total balances versus credit limits, recent hard searches, any public records like defaults or CCJs, length of credit history, late payments in the last 24 months. You don't need a perfect score, but they want a clean, predictable pattern.
So like a missed mobile phone bill from 18 months ago probably won't sink you.
Probably fine. But 3 missed direct debits in the last 6 months, that's a red flag.
Got it. And the third check?
Loan to value, LTV, the ratio of your mortgage to the property's value. The key brackets are 60%, 75%, 80%, 85%, and 90%. And here's where it gets interesting. Dropping from, say, 82% LTV to 79% can knock 0.3% off your rate. On a $200,000 loan, that's about $40 a month, $480 a year.
And that's often achievable just by overpaying a bit before you refix?
Exactly. Even 2,000 to 3,000 pounds can sometimes make the difference between an 81% rate and a 79% one. And that gap often pays for itself within a year.
Oh, that's actually really practical. Okay, so if my deal ends in, I don't know, the next 18 months, what should I actually be doing? Give me the timeline.
Right. So 6 months before your fix ends, that's when you start. First thing, get a completely honest picture of your finances. Pull 3 months of bank statements, categorize every single outgoing. You will almost certainly find $100 to $300 a month of spending that's just crept in. And the lender will spot it too, so...
Oh, I know that feeling. All those little direct debits you forget about?
Exactly. Then, check your credit file with all 3 agencies, Experian, Equifax, and TransUnion. They show slightly different information, and lenders use different ones. Look for errors, outdated addresses, old accounts that should be closed. Correcting even a single error can shift you into a better rate bracket.
And checking your own file doesn't hurt your credit, right? Because I know people worry about that.
It doesn't. Soft search, completely fine. That's one of the most common worries, and it's totally unfounded.
Good. And then the LTV thing you mentioned, work that out at this stage too?
Yeah, calculate your current LTV based on a realistic property value. Don't just rely on Zoopla estimates. Check actual sold prices for comparable homes on your street. If you're within a few thousand of a better bracket, that overpayment might be the single highest return move you can make.
And I'm guessing no new credit cards or car finance in that window?
No, and no buy now, pay later agreements either. Each hard search leaves a mark, and new commitments immediately reduce your affordability calculation. Just don't do it.
Huh, fair enough. Okay, 3 months out, what happens then?
That's when you start talking to brokers and lenders. A whole-of-market broker can see products that never appear on comparison sites. They also know which lenders are more lenient about specific things. Self-employed income, bonus-heavy pay, recent job changes, that sort of thing.
So get a decision in principle from a couple of lenders, check product transfer rates with your current one.
Yeah, and compare total cost, not just the headline rate. Arrangement fees, valuation costs, all of that. And make sure your income documents are up to date.
pay slips, SA-302s, business accounts if you're self-employed.
Oh, and for self-employed people, you mentioned something about not minimizing taxable profit too aggressively?
Right, this is a really important one. Lenders typically want 2 full years of accounts or SA-302s. Some accept 1 year, but the rates are usually worse. And if your accountant has been, aggressively minimizing your taxable profit in the year before you apply, that low profit figure is exactly what the lender uses to assess you. So you're kind of shooting yourself in the foot.
That's a tough trade-off for business owners.
It is, but it's worth planning around.
And then the final 6 weeks, what's that look like?
By then, you should have chosen your lender and product. Submit the full application, get the property valued, and this is the one I really want people to hear. Respond to any underwriter queries within 24 hours. Delays at this stage are the single biggest reason offers expire and people get pushed onto the SVR by default.
Which is always the most expensive option, right?
Always. Often 2% to 3% higher than the deal you originally qualified for. It's money thrown away because of a slow email response. Don't let that happen.
Okay, so what about actually improving your stress test results beyond the timeline stuff? Are there concrete moves people can make?
Yeah, definitely. So every pound of committed monthly outgoing reduces your maximum borrowing by roughly 180 to 200 pounds in most affordability models. So clearing credit card balances rather than making minimums, settling small personal loans if you've got savings sitting at low interest, consolidating debts carefully into a single lower payment.
And the little things too, right? Like switching to a cheaper broadband deal?
Exactly. Reviewing childcare arrangements to see if tax-free childcare or workplace schemes reduce the net cost. Canceling subscriptions you haven't used in the last 30 days. It all adds up. Oh, and most lenders let you overpay 10% of your outstanding balance annually without early repayment charges. Check your current deal's terms and use any spare capacity to reduce your LTV before you remortgage.
Right. And if someone's moving house rather than remortgaging, a bigger deposit obviously helps?
Yeah, family gifts with a proper gifted deposit letter, selling assets like a second car or investment holdings, using a lifetime ISA if you're a first-time buyer under 40. Or honestly, sometimes just waiting 6 months to save more if your circumstances allow.
What about extending the mortgage term? I've heard people talk about that as a way to pass the stress test.
So yeah, stretching from, say, 20 years to 30 years does lower the monthly payment and can help you pass affordability. But, and this is important, it means paying more interest overall. And lenders increasingly won't approve terms that run past retirement age unless you can show pension income. So I'd say use it as a bridge, not a permanent solution. Once you're through and rates settle, you can overpay to bring the effective term back down.
That makes sense. Okay, so what if someone does all of this and the numbers still don't work? Like genuinely can't afford it under the stress test? What then?
So don't panic, but don't ignore it either. Speak to your existing lender first. Under FCA rules, they have to offer forbearance options. Things like a temporary switch to interest only, a term extension, a payment holiday of up to 6 months, or a product transfer without a full new affordability check.
Oh, I didn't realize they could skip the full stress test on a product transfer.
Yeah, that's the thing. You're not a new customer. You're an existing one they want to keep. So product transfers are really useful in this situation. And that fear people have that asking for help will damage their credit, it's misplaced. A conversation about options is not the same as a formal arrears mark.
Oh, that's actually reassuring. But I guess the absolute golden rule is
Never just stop paying. Never. Missed payments trigger arrears, damage your credit for 6 years, and remove your best options with the lender. Always call them before you miss a payment. They can do so much more to help when you're still up to date.
right. Makes perfect sense. So, looking ahead, how do people kind of future-proof themselves against all of this?
Honestly, the best thing you can do is run your finances as if rates were already 2% higher than they are. So take your current monthly payment, calculate what it would be at 2% above your fixed rate, and try to save the difference every month.
Go on.
So if your payment is $900 and the stressed equivalent is $1,150, you put that $250 into an easy access savings account every month. Two things happen.
One, you build a buffer that could cover months of higher payments, and two, when you do refix, the higher payment isn't a shock because you've been living as if it existed for years.
That's so smart. And it's like, it takes what, 15 minutes to set up?
Yeah, open an easy access account with a rate above 4%. Several UK banks offer that right now. Set up a standing order for the day after payday, label the pot clearly so you don't dip into it for takeaways. That single habit honestly protects more households from repossession than any government scheme. I really believe that.
I love that. Okay, so let me try to pull this all together for everyone. The big takeaways: start early, give yourself 6 to 12 months before your fix ends, clean up your credit file with all three agencies, cut the unnecessary outgoings because even small subscriptions have a massive impact on borrowing capacity. Try to get your LTV into a better bracket if you can, and if things look tight, talk to your lender before you miss anything. They have options most people don't realize exist.
And build that buffer. Run your budget as if rates are already higher. That's the thing that turns this from a stressful scramble into something you've got completely under control.
Brilliant. Assad, thank you. That was genuinely really helpful.
Cheers, Angela. Happy to help.
Quick side note, this guide connects with other cost-saver blogs, especially Landlord Pitfalls that reduce rental yield, Me's Energy Performance Certificate rule changes that catch landlords out, and rent affordability mistakes to avoid.
Exactly, and reading those together helps you connect the dots across your household budget, not just this one topic in isolation.
And if you want to apply this immediately, jump into tools like Mortgage Stress Test App UK, Rate Rise Affordability right after this episode.
Primary sources used here include Couple Reviewing UK Mortgage Stress Test Results at Home and Financial Conduct Authority, so you can verify the data yourself and stay evidence-led.
That wraps this cost-saver conversation with Angela and Assad. If this helped, share it with someone who could put these ideas to work this week.
Your next step is simple. Try Mortgage Stress Test App UK, Rate Rise Affordability. Then read Landlord Pitfalls that reduce rental yield and use them together to take action today.